Everybody, thanks for joining us today. I'm Scott Huedepohl at Community State Bank, and we're doing this live feed today to try to figure out a little bit about what's going on in the housing market and with interest rates and all those good things. So, all right, we will kick this off. I have two really smart people with me today, and the reason that I asked these two guys to join us is because the market is really weird right now. I mean, I'm sure people are feeling that interest rates have kind of gone all over the place and all those things. But one thing is historically, it's weird, but it's not weird, if that makes sense. So for some people that have never been through this process before, or maybe we've been only through it one time, this can be a really daunting time to do things. But the gentlemen that we have here have been through it more than once, and I've been in banking for well over 30 years, and a lot of that has been in the real estate area. That's been kind of my love over that period of time, and making a lot of mortgage loans. So, Mike, introduce yourself, will you?
Michael Fohey. I run the mortgage department here at Community State Bank, and I've been in this business since the mortgage business since mid-80s. So I've seen quite a few cycles of down markets, up markets, high rates, low rates, prices up, prices down, and it's a journey. It's a cycle, but none of them last forever.
Great. Joe, introduce yourself.
Sure. Thanks for having me. I'm Joe Busch. I'm with Bear. Been in the real estate business for 28 years.
Wow.
Like Scott said, probably, hopefully seen it all. Maybe you've seen it all.
Hopefully.
Yeah. Happy to be here.
Great. That's great to have both of you joining us today. And hopefully, we're not going to take a lot of your time, but the goal is to get you better educated on what's going on and what we're looking at. We'll start with interest rates, Mike. I locked in a 15-year fixed interest rate on my house probably 3 years ago at 2.5%. Interest rates have gone up to 7%. They've come back down a bit. Now we're close to 2.5%. But tell us what's going on. Tell us, I mean, with interest rates where they're at now, is now the time to do something?
It's the time to buy a house, although, an interest rate is really important and impactful to your monthly payment. But I don't really think that should be your primary focus on whether you should buy or not. I mean, if you're looking at a property, you want to live in an area where your family is changing and you need more space, different style, don't let the rate dictate that. It's more a matter of, can you afford it now? And you're going to have different options to pick from. And then you look for opportunities to improve yourself as time goes by. I mean, we've been in our house 22 years, and I think we've had 6 or 7 mortgages. Anytime there was an opportunity, I took it.
Anytime were any of those mortgages foreclosed on?
Uh-huh.
Were any of those mortgages foreclosed on?
No, actually, I've actually made it through all of them. So that's a good thing. But there were times where, sometimes I took balloons because I needed funding for college. Then I went back to a fixed, then I went down to a 15. But it's really, really, truly looking for opportunities as you go forward, as long as you can afford it now.
The history of the interest rates and the slide that's coming up right now is the 40-year mortgage rates, which is really interesting. And it starts way off to the left there back in kind of when I started in banking. I remember a story, and I'll try not to bore you, but I remember going home to my wife, Andrea, when I was first in banking, and the Iowa equivalent of the WHEDA loan, can't remember what it was, but it went to 9.9%. And I was so excited because it didn't go up to 9.9%. It came down to 9.9%. And it was like, we can borrow money now under 10% to buy a house, so we have to do it. So the slide, talk a little bit about what's out there right now, Mike.
That's funny. Because I was in this industry when they fell under 10% too. People could not get in the door fast enough to get 9.9. It was crazy. But then again, at that point too, you could still get 10 and 11 and 12% CDs, which was kind of great. I didn't get any of them, but I didn't have any money then.
Sure.
But in any case, people, they took that And then as you can see the rates, I mean, they cycle up and down all over the place. It's just a matter of, you know, looking, like I said, looking for opportunities in the future to better yourself and jump on it.
When I look at that slide, what really catches my eye is, other than the last 5 years, which we'll look at here in a second, there's the last 5 years. So you can see we're at a higher level than we've been in that period of time. But if you go back one, please, Elliot, if you look at it, the interest rates right now over a long period of time are pretty normal. I mean, this is kind of where it's been over that long period of time. So again, the people that have not experienced this much, you know, they think that, you know, 2.5% is normal. As you can see here, that's not normal. I mean,
No.
that's very abnormal. And what's really normal when you look back on that thing is that we're in an area that's been pretty typical over the long period of time, and primarily coming out of the last recession, and then COVID and all those good things. If you go back to the 5 year one, that's not been normal. I mean, we're not in a normal time, and when we hit those low points, it's not normal. So I think what we're saying is that even though rates are higher now than they were, that's fairly normal, historically speaking, on where rates have been. 2.5% is not normal. So,
No, I mean, when we bought our first house, I got 7.625, I remember that. And I thought I had beat the system. I did. And now people will look at you funny.
Our second best market ever, with that 2000 to 2006 market, if you want to call it the best, where, you know, the values were the highest, the rates were between 5 and 7% the entire time.
yeah.
So these rates that we've experienced over the last 4 or 5 years is probably not typical.
Yeah. So you mentioned something, Mike, just a little bit ago, when you look at, you know, ARMs and different things like that. One of the things I always like to point out to people on the mortgage side, when you're borrowing money, it has what I call a call feature. I mean, you can pay that loan off at any time. Not, you know, you can pay it off by winning the lottery, but you can also refinance it when things. So as we go into the next step of this is, you know, the interest rates we see up and down, more normal over the last, you know, longer period of time than it has been over the last 5 years. Then it goes into the real estate part of it. And what I like to tell people is that you can't change what you pay for a house. I mean, if you buy a house today, you can't change that 3 years from now. But if you buy a house today and you finance it at, let's say, 6% or 5%, if the market changes, you can change that. You can call that and say, you know, we're going to refinance that at a better or lower interest rate. So Joe, tell us what's going on in the market today with inventory. And we saw for a long period of time, you know, if you saw a for sale sign, it was unusual because they were going so fast. What's happening today? Where are we at?
Yeah, some of that is still happening today. I would say that the market is probably providing more opportunities in the last 6 months than it has in the 12 or 18 months previous. More inventory is coming on. It's still moving quickly, but we're able to, but now we're actually able to get a sign in the ground, maybe have an open house, maybe show it a handful of times over a week or two. But still, the average days on the market from listing to closing is less than 2 months still today. So good that it's getting that it's easing, but the market is still very strong.
Okay. Nationally, we're seeing a downward trend, and as far as prices and everything else, why do you think in our neck of the woods we're not seeing as much of that?
Sure, yeah. I think it's mainly employment's very strong here, and it seems like everything related to this housing market, employment is the biggest factor. And to me, it just seems like there's lots of jobs, lots of opportunities. So people are gonna, you know, in our market anyways, they're gonna continue to move because of promotions, children, you know, growth, that kind of thing, or just the simple want to go and live somewhere different, so our market's always been driven that way. So usually in the big swings that you hear about in the paper or online, we typically don't see those here. It's very typical that, you'll see 5-10% moves in the market in a year. We saw maybe more than that the last maybe 24 months, but again, that's not real typical. Now I think we're seeing it flatten a little bit. However, I thought that the market was going to stumble, and it hasn't done that. And now I'm kind of more in the camp of that. I think it'll just simply land softly, and I think we'll go back to normal growth and not these monster hikes in value. But maybe we'll see 3 to 5% gains over the next couple of years.
The location that, I call it southeast Wisconsin. So, our markets, we're seeing Kenosha, Walworth County in this general area. For the longest time, it was historically an economic challenge. I mean, this area was a challenge, economically from what's going on. Today, it's almost completely reversed from that standpoint, because our friends to the south, as an example, I mean, there's so many people coming in from Illinois and obviously we're the beneficiary of that because we're the first counties to come to. So are you seeing some of that and some of that continuing?
Yeah, for sure. Even though the real estate values here now have maybe caught up to Illinois pricing, the cost of ownership is still far less.
Sure.
The tax burden down there is way different than up here. A $300,000 house there, the tax bill's 12 grand. Here it's 6 grand.
Yeah.
So, and I think that there is a quality of life factor that maybe the southeast corner of the state has. We're positioned really well, close to a city that's thriving and a lot going on, tons of growth. And then you've got the quaintness of these small city downtowns that have done great too over the last 5 years.
Sure. So I was as we were in the Burlington parade this last Friday night. That was pretty cool.
Yeah, it's great.
Yeah, it was.
Yeah.
It was. Your crystal ball, when you look at inventory, you said you're probably starting to feel some more come on. Do you see that increasing fairly rapidly or slowly?
So typically, if you look back at data, it says that the high point of inventory annually is in April and May.
Okay.
Good market, bad market, whatever you define those as, you'll see there's a spike in inventory. People get through winter months, they get anxious. It seems like that season starts earlier every year. It used to be not until April or May the market fired back up. Now it's like January 1 and the market's fired back up again. That's how it feels.
It used to be kind of cyclical within the school.
Yeah.
Get your house sold, could reposition before September.
And now we feel like a 2-week lag in June when school gets out, and then right back at it. So that's sort of changed. I don't think we really live in a highly seasonal market any longer. And I don't see that changing, but you will see inventory for the most part peak in April or May. So you bring all the inventory on, and then obviously you supplement throughout the summer and fall back into this type of year, this kind of year. But ultimately, you'll see it come on, and then it'll hopefully just, sustain itself and bring it, continue to keep that market rolling. So yeah, I see good things coming.
Yep. Going back to interest rates, Mike, one of the things we do here is we keep our adjustable rate mortgages. And so people understand, like we're a seller servicer for Fannie Mae. So all our fixed rate loans we sell to Fannie Mae. All our ARM loans we keep in-house. So we portfolio those here. We have always been really aggressive in our ARM rates for people to be able to get into those. What do you think about like a 5-year ARM right now versus a 30-year? And I know there's additional risk because who knows what 5 years is going to bring, and so it's not for everybody. But if you can save a point and a half compared to a fixed rate, is it worth doing it?
I do. Personally, I do. and I would do that right now if that was if I was in the market for a new house.
Mhm.
And I've told people this too, whether you take a 5/1 arm at 5% or a 30-year fix at 6.5, you will do something in the next 60 months.
Mhm.
You will refinance it. I will
Yep.
bet you lunch on that one. You just will.
Yep.
And if rates happen to not come down enough to make it make sense, you just go with the adjustment. So 1-year treasury plus 2 3/4. The treasury market will soften, and that rate adjustment's not gonna be that big a deal. I mean,
Mhm.
ARMs got a bad rap years ago because they were tied to ridiculous indicators or 10% margins, and that's really not true.
Sure. I also, and I know crystal balls, we look in those a lot and they're pretty cloudy and foggy, but I personally think that, I'm not saying the rates can't go higher because, they're trying to stop inflation. That's a whole another podcast, but when they slow the economy down, which I think they're going to at a pretty startling level, we're probably going to be seeing interest rates come back down. And that's my cloudy crystal ball, is that where they go, who knows, but I think at some point in time, this will personally backfire a little bit on what's going on with the interest rates nationally, that it'll catch back up itself. And I'm not saying to go back to 2.5%, but
No, it'll normalize a little more though. I
Mhm.
mean, it went up so quickly, it's bound to come back down. And part of that is Fannie Mae, securitizes the mortgage loans, sells them into the market. The market has to be comfortable in investing in them.
Mhm.
And you can see it going from 7.25 down to 6.5. That comfort level is, becoming a little more real for the institutional investors that buy them.
Mhm. And the other reason we do pretty aggressive on our arm rates is because we compare those to what we can invest in, like on mortgage-backed securities, and we prefer to give our customers that benefit instead of Fannie Mae as an example. So that's why we keep them pretty aggressive. So opportunities. Let's talk a little bit about that. We'll kind of wrap it up on that. If I'm a renter, um, if I have a house to sell and I want to do something different, um, what advice, Joe, do you have for those people?
Yeah, renters they have it a lot easier, way more simplistic than someone that has a property to sell. However, nothing's impossible. So the person that is in a lease, obviously you've got to time that a little bit as to when your lease, if you're in one ends. Pretty simplistic though. Give yourself 60 or 90-day window to be able to shop and look and find something that you like. Time that with with the end of your lease, and you're probably good. The person that has a house to sell, well, that's a little bit different. Definitely possible today. 18 months ago, almost impossible 18 months ago. Today, not so much. Obviously, the typical house is going to be more difficult because the buying public is large. The more specialty property, the higher end property, where the buying public is smaller, well, then you have a shot to be able to put your house on the market, find a buyer for it, time that just right so you can make that move. You really have to dedicate time and effort into planning for any of these moves today.
Mhm.
But your start off is to go get yourself pre-approved, make sure that you're ready, make sure your ducks are in a row, and it'll go pretty smooth.
Okay. Explain this, dig just a little bit deeper. You said 18 months ago that wasn't so much a case. Why was that, where you had a house to sell? Why is it different today?
There was so much cash
Yep.
in the market then that even if you were going to get a mortgage, and it wasn't like, if you weren't a 25% down super strong buyer, if you were a typical 10, 15, 5% down buyer, you were at the bottom of a pile of 4 or 5 offers. Now, so the cash buyer, the person that was writing a very clean offer, clean by no inspections, no financing, appraisals waived, all that stuff,
Mhm.
they were top of the heap.
Sure.
We'll see how that turns out later
Yeah,
on,
yep,
if that's the way to do it. Now things have come back to earth, still aggressive, but not that aggressive.
Sure. Okay. Mike, and Joe said, get pre-approved. What does that mean? What's that look like?
Oh, it's a simple process. With Community State Bank, you can do that online. Go to our website, go to the mortgage section and do the pre-qualification, pre-approval. Populates into our system. As soon as you're done, then either myself or Kim will get back to you. That's, if it's early in the day, we can do it the same day.
Okay,
It's pretty simple.
so it's important to check that out before you start making offers.
Yeah, and quite honestly, it's more important for the buyer to know what their payment's gonna be. I mean, we can approve people for a number and it's gonna be more than what most people wanna pay. So what their buying power gets them is important to find out.
Okay,
And from the seller's point of view, they want to see that to know that their buyer's good.
sure.
Yeah, so both of those are.
I'm seeing that now where buyers are like, I need a pre-qualification. They won't accept my offer without one. They don't.
Yeah.
Right?
Yeah, for sure.
So my final question is now a good time to buy a house?
I would think so. Yeah, that's not rate or market dependent. It's, if it's the right move for you, do it. An opportunity to change how that looks later, but you want like an area or a different house, don't hesitate on that.
Yeah, the most intelligent, the brightest real estate people can't time the market very well. So someone that's buying a house every 5 to 10 years, to be able to time it and get it just right is so difficult to do. You might hit the bottom or the bottom of your pricing, but the rate will be higher, so your cost of ownership will be the same. You might pay in a high market, but the rates are 3%. Too hard to do. The best can't do it. I don't recommend that a buyer even attempts to try to find that sweet spot. It's so hard to find. And if you look at the real estate investors out there, the folks that are building subdivisions and building houses, they've been doing it for the last 3 or 4 years in the highest market we've ever seen, and they're still doing it. So they're not even trying to time the market. So yeah, I would tell you that if you feel like it's a good time for you and what's going on in your world, then you should do it.
Great. Do you have any questions? No questions from anybody? Okay. Well, I really appreciate your time, both of you. And how do they get a hold of you, Joe?
Yeah, you can email me, go to the Bear website. You can email me at jbusch@bearburlington.com or j.busch. Either one works.
Okay.
Yeah.
Mike?
You can find me on our website. I think it's up on your screen too. Email mfohey@csb.bank, or you can call me direct, either way.
All right. So I just want to leave you with between what, the people that we have on staff here and the people that we work with within our communities, a lot of experience. And I think probably the most important thing to know is that experience really matters right now, because we are seeing some pretty major moves in like interest rates and different things like that. So I encourage you to find somebody that you're comfortable with and that maybe has seen a few of these along the way. So it's a little bit different time right now.
Yeah, call Joe, call me if you got questions and don't want to do them online, that's fine. Develop a comfort level.
Sounds good. Well, everybody, thanks for joining us today. We appreciate it. Give us a call, send us an email, whatever you want to do to communicate with you, and we'll get your questions answered. Thanks, and have a good day, everybody.